Fellas, you know Degree Cool Rush deodorant, right? Well, last year they changed the formula, and guys were mad about it. One dude even started a petition. So guess what? Degree heard us, admitted they messed up, and brought the original Cool Rush scent back exactly how it was. And it's in Walmart, Target, and other stores now for under $4. So grab some and remember why its cool, crisp, and fresh scent made it the #1 men's antiperspirant for the last decade. Degree Cool Rush is back, and it smells like victory for all of us.
Reality radio for a really great future. We're talking real money.
Hello, and welcome to a weirdly special edition of Talking Real Money, the radio show, the podcast, and now, for the first time ever, the behind-the-scenes video where you get to live the Talking Real Money podcast in real life in 2 dimensions with me, Don McDonald, and actually physically here in the Talking Real Money studios in Florida, Mr. Thomas C. Cock, ladies and gentlemen.
Or as I like to say it, 2 huge egos, 1 small studio.
So I had to build a new studio because my previous studio was less than 1/2 this size.
That's true.
And there was little or no chance we could fit both of our egos or our huge brains, or fat heads, huge brains.
Probably.
Into the same.
Yeah, we're here. I'm in Florida. All kidding aside, glad to see Don in person in 3 dimensions for the first time in 2 years. It's kind of weird.
He came over to the house. The studio's at the house. He came over to the house this morning, sat down at the kitchen table, and we were talking, and I went, "Oh, man, this is very strange. You're like 3-dimensional." Because for the past 2 years and 2 months,
yeah, it's been that long.
I have only spoken to this man via FaceTime.
Which is a better way to speak to me, frankly.
Apparently. So what I did for the rest of the day, I just held my camera up in front of me, and I talked to him through the camera. Made it feel more normal.
Please. Anyway, no, it's great to be here. I didn't just come to see you, as you know.
I know.
So.
He came for the soccer game.
Yeah, so you can figure out which game. It's not that hard.
Did you come for Orlando City B?
Yeah, never miss those Orlando City B games.
Orlando City B. We now have Orlando City B. They play in Kissimmee.
A team I probably might be on. I don't know. So it's possible.
That's not happening.
No. Anyway.
All right, let's see. Today we have a fascinating topic for you. Oh, by the way, I want to give you the phone number so you can call and join us here in Florida. Pretend you're in Florida, where it's 75 degrees and sunny. 855-935-TALK is our number, 855-935. Oh, is it low? Tom needs to boost. I need to boost Tom. Okay, I'm boosting Tom.
Okay, whoa, there we go.
Wow.
That was I just went way up, and now I'm back
is he
down.
okay now?
Okay, well, we'll find out. They'll let
Is
us
Tom
know.
okay?
Yeah, we'll find out.
All right, then.
Yeah.
All right, just to
Okay.
make sure
That
everybody
sounds better.
thinks Tom's
Yeah.
okay.
Okay.
All right. And it's the first time you've been in the studio.
I know.
I usually mix you from afar.
Which is
mix you from up
mixed
close.
better from that distance, as you well know. So
okay, so here's the deal. We hate something with a white-hot passion. No, not indexed annuities. Although that is one thing we do hate with a white-hot passion. No, we hate stock picking contests. Oh, did I give the number 855-935-TALK? I think I started you and you interrupted.
that would be typical.
Yeah. We don't like them. We hate them. And it was fascinating because we've talked about them several times. But today in the Wall Street Journal, Jason Zweig sort of took him to task. We thought, Jason, a little wimpy this time. A little bit wimpy.
You know, I wish he had been more affirmative about. He was picking on schools that have contests, groups that have contests for young people to pick stocks, and he was talking more about them using leverage too, which is totally outrageous, completely outrageous. And so here's the thing: these stock picking contests. Now you know that we have said bad things about this for years.
Well,
why?
Because
Why are you
it
such
teaches
a nattering
kids to
nabob of
gamble.
negativism? Yeah, no, I mean, it really does. Are you going to teach them, as Jason pointed out in the article, to be drivers by running red lights, to not pay attention to traffic signs?
That's what a lot of them do.
To take risks that they don't need to? I mean, it's...
Well,
why?
he even said teach them to crash their cars so the survivors are going to be better drivers.
Exactly. They'll know the Okay, that's one. But here's another one. Some of these kids that won these contests, which he points out in his article, they took like $100,000, leveraged it up, and their $100,000 was $500,000 in a few weeks. Now, do you think, could you or would you be able to stop after you did something like that? I couldn't. I mean, no way. That would be, wow, I could make $400,000 in a couple of weeks.
Again, it teaches this is how gambling addicts are created. You win and you win and you win. And you feel so good about your skills and you're going, well, this can't end. I'm going to be good forever. And then you have an addict. You have somebody who's addicted to stock market gambling, which is no different than gambling on horses or football games or in a casino.
And we know unequivocally the people that end up with more money use low-cost index funds. They hold thousands of stocks. They don't try to pick stocks, individual stocks. They don't try to time markets. They don't pay attention to the latest, greatest thing. We know that, and yet here we are teaching young people the exact wrong thing to do. So, yeah, I'm with Jason. I wish I said he'd been a little bit stronger. This comes up from time to time in my own personal life where I definitely get down on it. And when I hear of it, I try to stamp it out because this is not teaching children about investing. This is truly teaching them about gambling, no question.
And one of the biggest sponsors of stock picking games and a national stock picking championship competition is SIFMA, which is let me make sure I get their little name right. SIFMA is the Securities Industry and Financial Markets Association, a trade group for the stock brokerage industry. They're big advocates. And when we come back, I want to talk a little bit about their excuse for this, their excusing of this behavior.
Tom and Don are talking real money.
Is your portfolio a mess? You may have a case of hodgepodgeitis, but don't worry, we can help. Just set up a free, no-obligation meeting with a Vestory advisor at Vestory.com. No sales pitch guaranteed. That's Vestory.com.
Your guides to a really great financial future. Tom and Don are talking real money.
Welcome to the show where I neglected to turn on Tom's mic. So
Come
we're going to
all this way. I'm like 8,000 miles from home, and I don't even get a microphone. I mean, come on, this is
What
outrageous.
is this, the Antarctic?
I mean, okay, 9,000 miles away. Well, the weather's 9,000 miles difference. I'll tell you that much right now.
Hey, but on the podcast, they're going to hear you fine. I checked the mix. It's okay.
I mean,
It's just
great.
on the radio
The
show.
tape delay. Yeah, okay, never fails, right?
Yeah, and by the way, if all goes according to plan, for all of you listening at home and the like, I am going to try to turn this into a fancy schmancy video where I might even leave some of the breaks in.
No, do not leave the break.
I
God, I got to remember to
I have all the power.
take it down a notch.
I have all the power.
All right, fair
so
enough.
I might leave all those in. And so check those out on our YouTube channel because we have a YouTube channel. I wanted to mention one thing. The SIFMA, the Securities Industry Finance...
This is an industry group.
Yeah.
Yeah.
That it's promoting buying and selling stocks. Because remember, Wall Street wants you to buy and sell as often and as fast as you possibly can.
Keep it up, you know.
The more you buy and sell, the more money they make. Money in motion makes money. Money at rest makes you money. Not them. They hate that. They hate that stuff. So here's what somebody from the industry group says. This is a woman by the name of Melanie Mortimer. She's the president of SIFMA. She goes, it's important that we recognize that simulation plays but a small part. The real focus is the curriculum, which is all about the fundamentals of investing in capital markets. Well, I went to their curriculum. And their curriculum page starts with a page that says Understanding Capital Markets and Wealth Creation for All. The headline of the page, when you click on the link,
Yes.
is Tools for Enhancing the Stock Market Game.
Oh, the old stock market game.
That they're,
yeah.
of course, de-emphasizing when they're totally emphasizing it.
Yeah.
They have a vested interest in getting kids indoctrinated into trading. And you, parents, I know you're parents, very few children, unless you're the children of the guy who made us use the word cheesecake.
Yeah.
Parents, listen to me very carefully. Listen, this is very important. If your kids are playing the stock market game, have a fit. Say, why are you teaching my children to gamble? And if your school administrators or the teachers want to argue that point, that this is a legitimate teaching, have them call us.
Oh, by the way, I checked SIFMA's website a little further into it. They actually have a cooking class, too, where they take you out to Burger Master one night, McDonald's one night, Panera Bread. So they're teaching you some really fine.
Panera's okay.
Okay, they're like fast food still. So anyway, yeah, this is really awful stuff for young people.
Yeah, it's pretty bad. 855-935-8255 is our telephonic number for calling the show absolutely live. And somebody just did it, too, thank goodness.
Donna.
Yeah. Hi, Donna. Welcome to Talking Real Money.
Hi there, guys. I love your show.
Thank you.
I've been retired for about 5 years. I'm soon to be 65. I'm not collecting Social Security yet, living on my pension and dividend income. And I do have hodgepodgeitis. And I'm looking to...
It's curable, Donna. It's curable.
It's curable. I'm hoping that's the case. I'm in Fidelity NTD Ameritrade right now, thinking of just consolidating everything with TD Trade, which is also going to be, it's going to become Schwab, I guess, here shortly.
They're going to consolidate for you eventually.
Yeah, eventually that TD will be no more T or D.
Right. But I'm going to take my Fidelity over there to
yeah,
TD
that
Trade
makes
right
sense.
now.
Sure.
Everything's consolidated there. When they become Schwab, then everything will be there in one place.
Yeah.
And then I want to just go ahead and simplify my life, and I'm just thinking of reducing my portfolio to maybe 3 or 4 ETFs, like for instance, Vanguard Total World Stock, Vanguard Total World Bond, maybe an ETF that's a REIT, maybe a 10% REIT, another 10% Vanguard Small Cap Value, and that's it, pretty much, and then reallocate, a couple of times a year. What do you think?
I think that's good.
You listen to us.
I know, it's remarkable. But just to go back very quickly, not to get too far into the weeds, but what do you want your stock to bond ratio to be? Because when you say 10% each of the REITs and small cap value, I want to make sure that fits in your overall stock to bond ratio. What are you aiming for there in terms of risk and return?
70-30, and I do have the pension I can depend on. I'd even go 75-25 even. I have a pretty good risk tolerance.
Yeah,
you're Tom.
Yeah, actually, I'm 80-20.
Oh, fine.
Because I'm always above average. But here's the thing. So if it was a 70-30, I probably would have the small at 10 and the REIT maybe more like 7. Small knit there, and then divide the rest up between the U.S. and international fund. Then the 30 goes into the total bond. Pretty good spot, though.
Can you tell he does more of the day-to-day money management? It's like, here, tweak this just a little
bit, but I want to have a little more small than REITs. Over time, you're probably going to make more money. The REITs are going to be more of a not perform the same as the stocks. You're going to get some little bit of diversification there. But I think that's a great portfolio. Wonderful idea. One custodian, simple. Create it, rebalance it once a year. Boom, you're on your way.
And with that simple stroke, that's all it takes to cure your case of hodgepodgeitis. I pronounce you well.
It's so freeing if I can pull that off.
Yeah.
Thank you so much, guys.
Thank you for listening.
Donna.
It's a fascinating thing. People have a tendency, once the money's somewhere, custodian, mutual fund, whatever, that you can't get it back. It's like,
it's your money.
By the way, if you
unless you're that old guy in Spain who can't get his money.
We'll talk about that later. If you're moving your money to any of these major custodians, they will help you. Mm-hmm. They want to get the money from Fidelity to TD.
And they're really good at it.
They're good at it. And in today's world, I can remember, by the way, in the late 1990s, sending paperwork once to move money from, I guess I'll go ahead and say it, Merrill Lynch to Schwab. Mm-hmm. And they sent it back to us after about a month, said this wasn't done right or something. But anyway, the whole transfer ended up taking 3 months. Today, it takes literally, once the account's set up, everything, you can do it in about a week. Boom. It's easy.
Now, if those of you at home watching this video next week are wondering why I keep looking that way.
Yeah, I'm trying to figure out, you're moving all around in here.
No, I'm looking that way because he's blinding me.
Oh, with this shirt?
It's totally thrown the exposure off on that camera.
This is a little bit
Your shirt, literally,
neon.
it glows of its own.
Yeah, well, it was a gift, and I love this shirt. So
I love the shirt. It's
anyway,
a vestry shirt.
Yeah, it is a vestry shirt. So anyway.
That's the shirt right there.
Thank you,
folks.
Donna.
Thank
Do
you.
it. Get on it. By the way, if you call the custodian you want to move to, they will generally help you and make it simple. Not always, as you point out. The old guy in Spain.
Oh,
I
the
mean,
old
that's
guy
a
in
tragic
Spain.
story.
No, okay, tragic.
Well, it's difficult.
Okay, it's not tragic.
No, all right. Tragic's a
Yeah,
tad
I mean,
strong.
the guy
but
can't. The bank is closed, and he wants to go get his money out, and he has to go online to do it.
No, he has to set up
an
app.
appointment
No,
online.
An app.
It's online.
Yeah, all right, but he had to set up a new app to go. I mean, come on, give the guy a break.
Whiny.
Yeah, I'm old, but I'm not an idiot. Let's just leave it at that.
That was the name of the article in the New York Times and other places. But whining. That's what he was. He was whiny. 855-935-TALK.
Tom and Don are talking real money.
A second opinion could save your life either physically or fiscally. Let one of our Vestory advisors help you save your future at vestory.com, vestory.com.
For your real life and real future, Tom and Don are talking real money.
All right, I'm moving the mic around over here to the other side because we'll take questions in almost any form they're sent to us. We are so easy to question.
We've never taken one by smoke signals, period. Hasn't happened.
I can't see them in Florida. It's
I know.
all flat.
That's true. So it just
There's
hasn't
no
happened.
mountain. You'd have to do it from an overpass. It's funny. They built these new the overpasses in Florida just keep getting taller and taller and taller as more people move here. And I was on one the other day coming, and I'm on the top of this overpass, and it's downtown Orlando, but I can see all of the attractions at Disney. And it's like 30 miles away.
Wow.
It's like the only mountain in Central Florida, and it's an overpass.
I'll tell you one thing they do have a lot of if they don't have mountains. Lakes.
We do have a lot of
You
water.
fly in, you just go, God, where's the room for homes in all this? It's just water.
We will never have a drought.
It doesn't appear so, but I don't know if I'd be drinking the stuff out of the lake that's outside your door here. But okay,
it's not very. But if you boiled it, it'd probably be okay.
Okay, yeah.
Anyway, we take questions a variety of ways. You can call us at 855-935-TALK, 855-935-8255, or you can send them in at talkingrealmoney.com. Record them or send them, and we've got so many that have been sent in. We're really going to have to devote like 2 episodes just to getting through these because we're still in the middle of March.
Okay.
So here we go.
Let's move it.
Hi, guys. Absolutely love the show and appreciate all the great information you provide. My question is regarding the proper split of the equity portion of a portfolio between U.S. and international. I know you generally recommend VT for its simplicity, but on a recent podcast, Don recommended a caller split the equity portion 50-50. Okay, it's an approximation. Okay. Anyway, because VT is market cap weighted, it's roughly 60-40. Little higher on the international, but
No.
Yeah.
It's 60-40 U.S. to international.
Yeah, that's what he's saying.
Oh,
60
okay. I
U.S.,
thought you
40
said-
international.
yeah.
It's actually a little heavier international the last time I looked, like
Okay.
42 or something.
Yep, okay.
If I'm willing to put a small amount of effort to keep my split 50-50, U.S. international, as opposed to just using VT, what's the reasoning for keeping them split apart evenly down the middle, as opposed to just letting the split be determined by floating market cap weighting over time? I imagine it's something to do with buying the losers a little more and selling the winners a little more, but it seems to me when I buy an index that market cap weighting, I'm buying more winners, less losers. It seems counterintuitive. Buying low, selling high, et cetera, et cetera, et cetera. He said he looked it all up and it just got him more confused. We generally say 50-50 because it's easier.
It's easier, and over the long haul, it better represents market cap. In other words, there have been periods of time where it has been about 50% of the value is U.S., 50% is international. The work that we believe in, the academic work, really suggests that being an even split has made you a little bit more money and reduced the volatility just a bit.
Yeah, right now it's 58-41.
Yeah,
which is actually... It depends on whose market cap numbers you're following, because if you take what they're missing, a lot of the super smalls and the emerging markets in this fund. So when you factor those in, the split rises a little bit to where you've got more international.
Good news, by the way, you can buy into Russia. You can't sell, but you can buy stocks in Russia now.
Actually, I looked at my Schwab portal and they said, you're not buying, you're not selling. We're not doing any Russian trades.
Oh, you can't buy either. Anyway, so back to this question. There is no correct answer, number one, because the only correct answer we're going to know is in 30 or 40 years. Number two, there are people that say, your money is denominated in dollars. You live in the United States. Let the U.S. be the more dominant part of your portfolio. Okay, that might be okay in the long haul, too. Again, we don't know the perfect answer. And using Vanguard's very fine total global, which is an incredible product, 9,000 stocks. You get it for pennies on the 1,000, whatever. It's so cheap. It's so good. The only thing I don't like...
7 basis points now.
7 basis points. The only thing I don't like is I wish it had a little more small. I wish it had a little more value, but that's a nit.
But you can tweak those up.
Yeah, you could. You could add in an AVUV, for example. I know you've heard me say this before, but that would give you a little more small. You take 20% of the portfolio, do that.
He does love his
I
AVUV,
do. It's been a
doesn't
great
he?
fund. It's been a great fund.
He does.
So, but I think that's, honestly, in my heart of hearts, I don't think that's something for you to worry about very much.
Okay.
Period.
AVUV, though, a great fund. It's just another variation on an index concept, really.
Yeah. It's a little different, though, than what they've done with...
It's a little more aggressive.
Than Vanguard's small cap value, for example. And remember, it's an exchange-traded fund, so it's very tax-efficient as well.
Before we go to the next break, I've got a little gift for you since you're here in Florida. A little present from one of our listeners.
I thought just spending the time with you was the gift.
It's a little gift from one of our listeners. I just listened to the March 11th podcast where the first caller said to tell Tom he should stop trying to be so funny. I love Tom's jokes. Please, Tom, don't change. It's what makes the podcast fun. In case it matters, I'm 51 and have been listening for the past 9 months. Thanks.
I'm going to say thank you to my wonderful wife, Danielle, for writing in. Thank you, honey. I really appreciate it.
Tom and Don are talking real money.
Is your portfolio a mess? You may have a case of hodgepodgeitis, but don't worry, we can help. Just set up a free, no-obligation meeting with a Vestory advisor at Vestory.com. No sales pitch, guaranteed. That's Vestory.com.
Reality radio for a really great future. We're talking real money.
And just to make all of you in Seattle feel bad, we don't just have sun poking through. There's sun everywhere. And it's what's the temperature, John?
79, but I will point out last night we did go out rather late for dinner because our
your plane was late.
They figured out they needed 2 engines from Seattle.
One of the engines fell off.
But here's the thing. I was loaning Don and his charming wife, Debbie, my little windbreaker coat.
65.
They were passing it back and forth. Taylor and I were sitting there going, this is like really warm.
It was cold.
So anyway, yeah.
65.
Tough all over.
We've lived here now for 29 years.
Yeah, your blood is thinned.
Yeah, it's really thin. 855-935-TALK is our phone number, 855-935-8255. And we have another question, Tom.
Yes.
We're going to catch up on these questions one of these days.
Do
Came
it.
in from TalkingRealMoney.com. I am in the process of de-hodgepodging my portfolio. You keep on de-hodgepodging, you folks. Good job. Based on the great information from you two and Paul. There's that Paul guy again.
Paul.
He always manages to sneak
yes.
into our podcast, doesn't he?
Yeah, okay.
I know. Paul, hi, Paul. I know what I want my portfolio to end up looking like. Can you please discuss some exit strategies for doing this and address the following? Here you go. This is the following. You good with this?
Okay.
All right.
Mm-hmm. When you say exit strategy, I think she should call my ex-wife, but that's a whole other thing. But yeah.
See,
okay.
there was another one of those jokes. I hope you liked that,
Sorry,
sir. It really wasn't that good, but apparently you liked those.
I liked it.
You liked it, and the guy from North Carolina liked it, who you pretended was your wife.
Play well in the South Carolina area. North Carolina, pardon me.
ARKK.
Oh, my. And lunch was just starting to feel good having eaten it before the show.
That's the ARK Innovation Fund.
Good old Kathy
Wood.
Yeah.
It has sunk so low.
How low has it sunk? Sorry.
Do I just suck it up and take the loss or leave it for years because it will come back someday? I am in no rush, and it's less than 1% of my portfolio. In addition to bad jokes, he also sings.
That 1%?
Yeah, 1%.
Okay, we can answer that quickly.
Yeah.
Sell it.
Sell it.
By the way, you can book the loss if this is in a taxable account for use against a profit later. Sure, why not?
Yeah. carry
And
forward.
here's the thing. If you woke up today, would you go buy that fund? That's what I tell
That is
people.
the question. There you go.
I'd be like, I stole it. Yeah, I mean, the answer is no, you would not buy that fund, so get rid of it, clean it up, sell it. Now, if you have a huge gain in something, and you're trying to get, I ran across this recently with the infamous Barron funds where somebody had a huge gain, then you probably got to live with it for a long time. Different situation.
People, though, we all have an aversion to accepting a loss.
Oh, big
and
time.
Selling a fund means accepting that you made a mistake and you have actually lost money.
You made a bad decision.
You made a bad
and
decision.
You have to face up to that. So, yeah, that's hard.
Might as well
Sure.
do it. Get it done. Pull the Band-Aid off. Yank it right off. Ow! And then he continues.
Okay.
I have an actively managed fund with a 0.68 expense ratio.
Kind of spendy.
I'm thinking it's down, and so is the rest of the market, so it's a wash. If I sell it now, right? Thoughts? Sell
Again,
it now and buy something that isn't actively managed.
It's 70 basis points. I
Yeah.
think we just mentioned a fund you can own for 7.
Yeah.
So isn't that 10 times
cheaper.
Yeah. So, I mean.
1/10 the cost.
Thank you, 1/10. So that's a no-brainer to me, too. Again, is it a fund that you would wake up and buy today? The answer appears to be no. So I would clean it up. Yes.
That's all he has.
Clean it up. Yes.
He repeated himself. So anyway, that one's done.
Now, I mean, this is a very interesting because with the market volatility, with some of these ridiculously overpriced funds that have lost a lot of value this year, the market as a whole has not. It's almost a break even in a global portfolio.
Is it really?
It's quite close. It's down about 2% year to date. So we've had 2 winning weeks in a row. You just sort of forget because it still feels so unsettled from the war, et cetera. But and then people have a tendency to think, well, everything's gone down. No, everything hasn't gone down. There's been parts that have actually gone up. So yeah, the total world might be down more than that because it's U.S. dominated.
Down 5.
Yeah, but if you're in a more global fix with more diversification, you're down about 2.5.
A 60-40, global
Yeah.
60-40 is going to be down.
That's a little over 2.
A little
Yep.
over 2? Yeah,
Mhm.
about the same. 855-935-TALK. Call us. We love talking with you, and we love answering questions. It's what we do best and what we do most of.
Tom and Don are talking real money.
Is your portfolio a mess? You may have a case of hodgepodgeitis, but don't worry, we can help. Just set up a free no-obligation meeting with a Vestory advisor at Vestory.com. No sales pitch, guaranteed. That's Vestory.com.
Your guides to a really great financial future. Tom and Don are talking real money.
And the show /podcast/possibly videocast, which makes it a super combo cast this time.
Ooh,
This is like the
super
ultimate combo cast with Tom here in the Florida studios. It's over there. You can see him now because I just edited it where it points to him. I'm Don McDonald, and we are taking questions that were sent in via TalkingRealMoney.com, because we would be taking yours if you were calling us, but you're not, at 855-935-TALK.
I thought you were going to say because we care. That's why.
Well, we do, of course we care.
Goes without saying.
What do you think we're doing here?
I was waiting for dinner. I heard it was a nice place outside or
Yeah,
something.
I was going to make a pot roast, but
Got
Debbie,
shot down.
Debbie decided she wanted to go out to dinner.
All right. Well, it's good enough.
All right. So that's what we're doing.
She and Taylor, my son, who's visiting, and have been all day at Disney. I bet they're going to be tired, but we'll see.
Yeah, we've been working all day.
We have been.
We did not go to play at
Nope.
Disney World.
Nope.
No way. We are devoted to our craft.
We didn't want to go. That's the truth.
Okay. It's crowded. It's spring break is packed. You have to make a reservation
I know, that's
to
ridiculous.
go to Disney World.
I wonder what Walt would say about that.
He'd build another park.
Probably.
Just build another park. If there are that many people, I'm building another park. 855-935-TALK. That's our phone number. But back to a question that came in from TalkingRealMoney.com on the contact form. Hi, Don and Tom. Love the show. Really appreciate all the straightforward advice. I'm 43 and have taken your risk quiz and have scored somewhere in the upper 80s. Wow. And my portfolio is somewhat approximates this with about 85% stock, 15% bonds. I plan to work as long as possible, but with working fewer hours and taking more vacations as I get older. My 15% bond allocation is 1/3 total bond market, Vanguard, 1/3 Vanguard Total International Bond, and 1/3 Vanguard Tips. All of the bonds are in my 401k for tax optimization. Lately, I've been questioning my bond allocation. You and the rest of the world.
Yeah, it's a very unusual year where the total bond fund, VBTLX, is down almost 7%,
Yeah.
while the total stock fund is down 3.9%. So you've had both of the major asset classes are underwater, and the bonds have lost more.
But
Weird.
we have been saying forever that the negatively correlating aspects of these kinds of investments do not exist in the short haul. Sometimes internationals and U.S. stocks go up and down at the same time. Sometimes they don't. Sometimes bonds and stocks go up and down at the same time. Other times they don't. They don't more often than they do. So
Yeah, no, and okay, you're 40s? Is that what I heard? I mean, young.
yeah, it's 43. But
and
I have more.
But you only have 15% of your money in bonds. That's still a small part of your overall portfolio anyway.
But he's still questioning his allocation.
Okay.
Particularly given the recent performance of the I bond, the Treasury I bond that everybody's salivating over because it's yielding 7.
Yeah, for
but
the moment.
you can only do $10,000 a year per person. I would not go performance chasing, he says, so any change I make is going to be long term. My goal with bonds is to temper volatility.
And that hasn't worked this year.
Good. And hopefully keep up with inflation, i.e. 0% real return. Anything above that would be a bonus. That being said, doing more research into I bonds has got me curious. Even when inflation is negative, the composite return can't be negative. No, it would be 0.
Yep.
So the real return can't ever be less than 0. Even with the fixed rate currently being 0, the nominal return is going to be 2 times the CPA rate because it's set every 6 months. Am I missing anything? Would I be crazy to start all future bond contributions to solely I bonds while going to a 100% stock allocation for my 401k? For some context, I also max out my backdoor Roth for my spouse and myself and max out HSA and 401k profit sharing while contributing to a Vanguard brokerage account. The total amount contributed per year is around $135K. Thanks for any advice you give.
Wait, $135K are going into those accounts?
Yes.
And you're 40-something?
Yes.
I'd say worry about nothing because you're a great saver. But, okay, first of all, I bonds, I know you love them.
I do. I like.
I think they're gimmicky. I think they're a gimmick.
But they're not a gimmick that really pays 7% when we have inflation.
Today.
Yeah, that's all I'm looking for.
Today.
I only have a tiny fraction of my bond portfolio.
And you can only own 10,000 each.
It's only a little bit.
So back to the question at hand. So if you could have just one type of bond, is that what I'm getting?
Yes.
Should it just be the I bonds?
Yes.
Wow. I'm going to say no for reasons of diversification because I want my bonds to be diversified, same as my stocks.
I agree. And even though you have a period here where you have a negative return on your bond funds, the yield on those bond funds as rates rise is rising.
Mm-hmm.
So you're diversifying your portfolio. There will come a point when either interest rates plateau or even maybe someday fall. But along the way, your rate is going to be rising, and you're going to have those higher coupons coming in to make up for some of the losses.
And what is the coupon rate now on the VBTLX as we speak?
I don't know.
I thought you would know that. I thought you had the inflation protection. So, I mean, you could use the I bonds as a substitute for the TIPS fund. I think that would be legitimate.
Yeah, it would, because the TIPS fund is going to be volatile.
Yeah, it's going to move around, and it's a fund, so you're going to have, again, these periods of time where it's underwater. But
the yield is about 2%.
Yeah, so, okay. So, that's probably fair. So, yeah, you could take the I bonds, put them in for that third of the bond allocation, keep the other third in U.S. and the other third in international, a more of a global. You get some mixed maturities in there, some mixed types of bonds. I think that just makes more sense.
Now, this next question, I'm going to send you.
Oh, goodness sakes.
I'm going to send this one to you because I can't possibly read this on the air.
No.
Do you see why?
What is that? It's like 80 mutual funds.
I can't read that
And
one.
God bless. Okay, we need to let people know.
I can't do that.
If you want that type of work, you're going to have to send. We're going to have to send that to an advisor.
Yeah,
we can't do this on the show.
It's
just too
like,
lengthy.
It's like.
What do you think of these funds? Well, I think some of them are good and some of them not as good.
And not only that, it's for an HSA, which
And I just came across. I came across this today. I came across this today, and you know what I recommended?
What?
The Vanguard Life Strategy Fund. It's like 80-20.
Oh,
it's one, and it's cheap. It's one fund. It's all taken care of for you. These are young people in their 40s, and just put it in there and don't worry about owning all. I mean, goodness
So
sakes.
you're talking about the Life Strategy Growth Investors?
I believe that's correct. Yeah, investor shares. It was, I forget how many basis points. Not very expensive. It's fairly diversified.
14 basis points. It's got about a 2% yield. And a portfolio that is, in fact, ready, set, 77. Yeah. So 77% stock.
You don't mess with it. You just put it in there. And honestly, I have an HSA. I don't even know how much is invested. I think mine, I have to go in every month or something and add the money to the stock. Anyway, it's a lot of wasted time and energy. So,
I'm forwarding this question to you.
And I'm just going to go out on a limb. I'm not going to answer it.
No, you're going to give it to an advisor.
Oh, okay, because they're asking about a various group of funds and... No, look how many those funds were. There were
I know,
like
you're going to give it to an advisor. It's just too many funds to read on the show. That's all I'm saying.
Nuts. It's nuts.
It's a lot of funds to read on the show. And what he's talking about is you go to Vestory.com, VESTORY.com. You can give these kinds of questions to our advisors. They will look through. You just send them the portfolio.
Yep.
They'll ask you to send it to them, whatever your choices are, and they'll say, okay, this is what we would suggest you do. And guess what that costs?
Zero.
Yeah, that's correct. Cost zero. And will you get a sales pitch? No. If you want to become a client, we'd love to have you, but you're not going to get one.
Tom and Don are talking real money.
At some point, most investors need professional financial guidance. So get a little bit of free help or a lifetime of affordable 100% fiduciary guidance at Vestory.com, VESTORY.com.
For your real life and real future, Tom and Don are
Watch the
talking
video.
real money.
Oh, hi, everybody. Welcome back.
No is the answer. No, Mo. Wouldn't be funny.
Okay, that was a question.
Inside.
No, I'm going to ask. I'll ask the question on the podcast.
Not now. We'll do
I don't
it later.
have time now.
I know. Now we need to talk about retirement. You need to get your tickets. It's coming up fast. Paul Merriman, Don and Tom, estate planning, housing, Social Security, Medicare, Apollo from Dimensional, all great speakers. One stage Saturday, May 14th in Bellevue, Washington. You got to pay for those because it comes with a sandwich. If you're out of town, want to do it online,
and
you're going to give you a free
it
sandwich.
comes with parking.
Parking and a sandwich. It's a great deal.
Parking and a sandwich, and Curly will be there for you right there. Curly.
Retiremeet.com. Retiremeet.com.
Your white hair makes you look like you could be curly more.
Stop it.
I got the mohair.
Come on.
Mohair. It's like a mohair suit. Mohair run. Go to retiremeet.com. Retiremeet.com. Spelled either way.
We hope you realize that the information provided on Talking Real Money is for informational, educational, and hopefully enjoyable purposes only. Providing personalized financial planning or investing advice takes time, so please consult with a really good fee-only fiduciary investment, tax, or legal advisor. We know a good one. Investing must always involve risk. In other words, you can and probably will lose money at times. Also, as much as you want it, no one can accurately and consistently predict the future, so past performance doesn't tell you a darn thing about what the future will bring. Unlike many other programs that say something similar, Talking Real Money is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Apella Capital, a fee-only registered investment advisor. Thanks for listening, and please visit TalkingRealMoney.com for more information and disclosures. Are we done now?